Welcome to our first panel debate of the day. Is there anything super about this commodity price cycle? We'll be exploring the key issue facing the natural resources industry, whether post-pandemic recovery programs and green infrastructure investment will drive a prolonged period of high raw material prices. The answer to this question will determine where hundreds of billions of dollars of capital are invested over the next decade. Now, commodity bulls think prices will remain high thanks to stricter climate policies and fewer new sources of supply. The bears, however, say demand in China is slowing. They insist Europe's Green Deal and Joe Biden's American jobs plan are no game changers for metals demand. So let's hear what our speakers have to say on the matter. I'd like to welcome Ben Cleary, who's a partner with Tribeca Investment Partners, Asia, Chief Economist and Head of Macro Strategy for Macquarie Group, Rick Deverell, Argonaut Fund Management's Executive Director and Head of Funds Management, David Franklin, and finally, Dato Yeo, President of Apical Group. Thank you so much to all of you for joining me. I'm really hoping that a little later in the session, I'll be able to put forward some of the views of our delegates. But for now, perhaps we can start with this. Ben, I'd like to come to you first. Do you think we are in a commodity super cycle at the moment, or are we just seeing sort of super commodity mayhem at the moment with sort of energy prices, soaring on the one hand and things like iron ore collapsing on the others? I mean, how do you assess this incredibly volatile environment that we're in at the moment?
Thanks, Neil. Look, I think we are in a commodity super cycle for commodities that are going into the decarbonisation and electrification of the world, battery metals and clean energy commodities. I think producers of those commodities will have super margins for the rest of the decade. We're seeing this manifest itself in inventories. You're already seeing commodities like copper look as though they're going negative in global inventories. Commodities like phosphate will also go into negative status early next year on our thinking. So there is a barbell. I think some commodities will certainly do better than others. You mentioned some of the more traditional steel-making commodities such as iron ore and coal certainly pull back in recent times off the back of a very sharp pullback in Chinese property markets, but we're more focused on the decarbonisation beneficiaries such as base metals and battery metals.
Okay, thanks, Ben. Well, we'll come back to some of the points you mentioned there, but if I could bring in Rick now from Macquarie. I mean, Rick, I think you're slightly more sceptical on this idea of a super cycle. How do you see things from Macquarie? David, if I could just bring you in really with the same sort of question. I mean, do you think we are in a super cycle, or what we're seeing is just the results of a sort of a snapback in demand from, the pandemic that we've had, and as these sort of lockdown restrictions ease? Which camp do you fall into?
Yeah, Neil, look, we see it as being a bit more nuanced. I think clearly, we see the long-term energy transition will drive demand for commodities, and we see that as a 10 to 20 year transition and time frame, and we're very bullish on commodities like copper and nickel and lithium that will be the beneficiaries. But on the other hand, I think there's commodities like iron ore.
Thanks, Neil.
and
look, it has been an extraordinary cycle, but as always with commodities.
Perhaps we could just let David finish his answer. Rick, we were just on a slight delay there, then we'll come back to you. But David, if you could just continue, thanks.
Yeah, sure. So, but there's commodities like iron ore and thermal coal, where we don't see a lot of price upside over the medium term. So it's a bit more nuanced than that. I think what we've seen really over the course of the last year is the benefits of global stimulus boosting returns. And I think the next couple of years is going to show a bit of a moderation and a consolidation. But I think long term, that energy transition theme is strong and will be the key driver of resource markets.
Okay, thank you, David. Rick, so, can we just come back to you now? I was saying earlier that you are a little bit more skeptical on this thesis of around a super cycle. Perhaps you could just explain to us why that's the case. I'm terribly sorry about this. We seem to be having all sorts of technical issues with the platform this morning. In which case, let's switch to Dato. Can we talk about agricultural commodities at the moment? We've focused a lot in the opening remarks from David and also from Ben around industrial metals and some of the steel-making commodities. But agricultural commodities, we've seen some pretty big gains in things like the soybean price, palm oil. Are agricultural commodities coming into a super cycle because of, I don't know, extreme weather conditions, growing global population? How do you see the agricultural space?
Yeah, sure. So in the veg oil sector, we experienced some record prices this year. Key drivers were biofuel policies and adverse weather. As usual, the two factors we have least control over, i.e. government policies and weather, have the most impact on the sector. Typically, the veg oil and grains complex can correct demand-supply imbalance within a span of 2 to 3 years, as the planting hectareage of annual crops such as soybean, canola, corn, sunflower can be easily adjusted to prices. However, what we are seeing now also is higher crude oil prices, and this is pushing up the running costs on farm equipment, fertilizers, and logistic costs. Thus, the expectation is that even though prices will correct through the typical short agri price cycle, cost pressures and ESG considerations will likely result in average prices to be higher than historical for a while. Of course, I think much will also depend on how renewable biofuel policies evolve. Also, adverse weather are happening with increasing frequencies, causing higher volatility and higher risk premiums.
Okay, thank you, Dato. There's a couple of points I'll come back to later on there, especially around the biofuels point. But Ben, let's just come back to you quickly. You sort of mentioned the battery metals in your opening remarks, but I mean, China at the moment is still the biggest consumer of things like copper, nickel, lithium. I mean, if that economy slows because of what we're seeing in the property market at the moment, also what President Xi is saying about common prosperity and wanting to direct capital away from the property sector, which is still the biggest driver of the Chinese economy. I mean, can these prices really hold up? I mean, is green demand going to come through quick enough to offset a slowdown in China?
Yeah, look, I think what we're seeing in China is almost similar to the automotive industry globally, where you're seeing very big pressure on the global auto sector with supply chains, etc., and big reductions in overall output. But it's coming from traditional ICE, petrol engine automobiles is where you're seeing the cuts. Everyone's happy to cut petrol cars. They're not cutting electric vehicles production. In fact, electric vehicle production is growing really quickly. It's the same in China. You're seeing big pullbacks, obviously, in the property market and some local government spending, but certainly anything to do with renewable energy is growing very strongly quarter over quarter, year over year. Money's flowing freely into the grid. You're not seeing any sort of pullback in spending there. So, I would argue that, whilst you are getting, certainly a property slowdown in China, things are still kicking along nicely for, any of the sort of decarbonisation beneficiaries. And you're seeing that, even in A shares, most of the, battery makers and input providers are hitting all-time highs at the moment, despite the rest of the economy slowing down. At the same time, I think the percentages that you mentioned are decreasing. Certainly, for the first time in my career, a whole lot of these commodities are are actually becoming far more global in their demand skews and China is becoming, somewhat less relevance. And, you mentioned copper. I mean, despite all the talk about housing slowdowns, copper inventories have continued to go lower in the last month. And other commodities like, nickel, you mentioned the same thing. So I think we certainly have to, be mindful of this property slowdown in China for some commodities, but I think generally speaking, base metals seem to be looking through the short-term slowdown, and probably, more broadly for the commodity complex, where I think, the markets are now starting to think about some stimulus and potentially some credit growth in the first quarter of next year.
Yeah, and I think your point on the copper inventories are a good one. I mean, they reached sort of critically low levels in London last month, and they really haven't bounced back too much further. So that's something certainly worth keeping an eye on. So anyway, I'll cut to David. I mean, look, David, can I come to you with the same question as I asked Ben there, just around China? I mean, are you worried about the slowdown that is happening there, particularly in the property sector, and its impact, or its potential impact on commodity prices anyway?
Yeah, look, I think you have to be cautious around China in the short term. But I think, as Ben alluded to, the energy transition is not a 2-year event. It's a 10 to 20-year event. I think what China has shown is it takes a long-term view, and what we're seeing now is a structural shift in the way that it configures its economy. Part of that is deleveraging their property market, and I think that'll take probably 12 months to roll through. But I think the big picture is the demand for particularly the battery metals is very strong. And if you take lithium, for example, the current lithium market is something like 300,000 tonnes per annum. In 10 years' time, that's going to be 3 million tonnes per annum. So there's massive growth. The nickel market will double in the next 20 years, and the copper demand will continue to strengthen. So, we think that the outlook is very robust, and China will be a big part of that, notwithstanding some reconfiguration in the short term.
Okay, thanks. Dato, can I just come back to you just on this point around biofuels in the agricultural space? I mean, is that a new structural driver that's coming through in terms of demand in the agricultural space? And perhaps you could explain to our viewers exactly what this biofuel demand is. Presumably it's renewable diesel, some products like that.
Yeah, it's renewable diesel and also bioethanol. So it has been around for quite a number of years, but I think, like for example, in US under the current administration, I think they have the expectation is that they will increase the biofuel mandate. Likewise, even in Indonesia, the support is pretty strong. So on a global basis, almost 15% of the vegetable oil globally goes into the biofuel sector. But you can see in some countries like Argentina, it could be as high as 70%. In places like Europe, like the rapeseed, close to 40%. So it actually varies here. But globally, about 15%. So that's very significant, and it does swing the demand substantially.
So we're seeing competition then between crops for food and sort of consumption on the one hand and biofuels on the other. There's a tension between the two.
Certainly, I think biofuel is plays well when soft commodity prices are low, but certainly in this heightened price scenario, then again the food versus fuel debate comes up, and then clearly I think quite easy to understand that food will win over fuel eventually, as governments all over become more concerned about food inflation, right?
Okay, thank you. Now, third time lucky, I'm going to try Rick again. and see if he can actually hear me now. Rick, are you there? No, I can see him, but I can't hear him. Okay, in that case, Ben, I'm going to come back to you. We've talked a lot so far in this session about demand for battery metals, some of these industrial commodities. But we haven't mentioned much about the supply side, and I think that is going to play an important role if we're going to see a super cycle. I mean, David was talking there about some of the demand numbers that are coming through in terms of what lithium might be needed, what copper might be needed. I mean, where is this going to come from? I think lithium, there might be more of it than say copper, but I mean, it's a real issue, isn't it? Because the mining industry hasn't been investing that heavily in new supply.
No, that's right. I was just about to say, I think, Rick's struggling a bit like being short the commodity sector the last 12 months, being bearish, not getting much of a run today. But look, I think in terms of, supply, the common issue across all the major mining companies are that they don't have a mandate to grow. They've been returning capital. They have been spending, at the margin or, relative to historical levels, very small amounts of capital on organic supply. And, at least until this point, we've seen almost no M&A in the sector. So there really is a supply, issue that runs right through this decade. In the absence of major capital spending from the major miners. This has obviously been exacerbated by COVID, particularly in South America. You've had all sorts of labour issues around mine site closures. In Australia, you've got all sorts of COVID issues around borders. As David would know well, with the Western Australian border lockdown, you're seeing, what is approaching hyperinflation amongst the mining industry. With the complete lack of labour availability, you've got air leg miners being paid $800,000 a year to work 6 months of the year. So there is supply side issues. 50% are COVID related, 50% are more structural. They're going to, confounding those issues is the complete lack of capital spend by the major mining companies.
Okay, and just around the sort of the battery metals we've mentioned, I mean, where do you see the supply issues being most acute? Is it copper?
That's our opinion. I think copper's again it's got a sort of multifaceted supply issue. The first is that copper ore bodies are pretty hard to find. If you look at the top 10 mines on the planet today, I think the average discovery of those top 10 mines was 1930s. There's only one of the top 10 mines has been found in the last 20 years. So, generally speaking, copper ore bodies are hard to find. I think generally speaking, second big issue is that grades globally are declining and ore bodies are getting deeper. So costs of production are increasing. And third of all, you've got this very dramatic demand surge coming from the electric vehicle and general electrification strategies of all the G20 governments, which in our view historically is a far bigger demand pull than what we saw in the 2000s from Chinese urbanisation. I would say that copper has the most dramatic demand and supply deficits through the middle of this decade, but I think you could also say that other commodities like nickel, lithium, cobalt also fit into that category.
David, I just come to you. I mean, you mentioned lithium earlier. I mean, I think unlike copper, for example, isn't there lots of lithium in the Earth crust that's quite easy to find? And certainly in Australia, we're seeing a lot of companies raising money to explore for the commodities. So, I mean, is there a danger that supply does catch up with demand in that particular commodity?
Yeah, look, I think lithium's interesting, and it's part of the attraction of having lithium-ion batteries. Is ultimately there's plenty of lithium, right? So I think your point is a good one in the long term. The way I see it is in the short term, what you've got is demand for lithium really surging, but it takes time to bring new projects online. So if you take a 10-year time frame, I see that lithium has a good probably 3 years of excessive prices before supply catches up with demand. I think if you look at copper and nickel, it's a bit of the other way around, where you've got some projects coming on stream. You've got Indonesia looking to ramp up nickel production, and a few major copper projects starting to ramp up, which will sort of balance out supply and demand over the next couple of years. But then as you look 3 years to 10 years out, that's where you get bigger shortfalls in nickel and copper. So, I think each commodity has its own issues that you need to consider.
And how do you think about technological risk? I mean, something like lithium getting engineered out of batteries, or nickel sort of being engineered out of batteries, and perhaps that demand not coming through. I mean, we keep reading lots of stories about new innovative battery technologies coming through. I think we'll hear from Robert Friedland later today on one of his companies. I mean, how do you sort of assess that?
Yeah, look, I think on the lithium side, I think it's unlikely it'll be manufactured out of the process. I think we're seeing it already on cobalt, which because of the risk of supply, you are seeing that manufactured out. And in fact, nickel at the moment is becoming a bigger proportion, so people are switching to nickel. The way I think the industry will go is there'll be two main batteries. One is LFP, which uses essentially lithium phosphate, lithium ion, which is for the base model vehicles, and then you'll see nickel used in the vehicles that need more power and range. Longer term, I think there is a risk with nickel, but it's probably 5 years plus out. But ultimately, you just need to watch closely and monitor new technology developments.
Okay. Dato, just come back to you on the agricultural side of things. I mean, I was at the COP26 summit. I mean, it's quite clear from all of the research that was carried out around that event that we are probably headed at best for a 1.8 degree rise in temperature. We've already seen what a 1.1 degree rise in temperature has meant for extreme weather events. So, I mean, is it right to think that the agricultural industry is going to see more of these events, and that's going to cause more volatility in prices and sort of more squeeze on the supply side? And is that another reason to think that prices are going to remain elevated because there'll be that sort of risk premium almost in the price?
Yeah, I think the short answer is that we do expect prices to be more volatile, particularly with adverse weather, happening more often. But perhaps allow me to share the perspective on price trend from an agri-commodity producer's point of view. Like in our case, Apical is the top global supplier of sustainable palm oil and part of the Algae Group, which essentially develops natural resources. As a player in the commodity market, we are, like everyone else, a price taker. Nothing much we can do regarding prices, except, apart from ensuring that we have a good and robust risk management framework in place. However, on the operations front, regardless of where the price cycle is, we constantly focus on QPC, quality, productivity, cost, and on sustainability. These two aspects are embedded in our business strategies as well as in the core values of our culture. By focusing on quality and productivity, we ensure that our unit production costs will be the lowest, and hence we will be the last man standing, so to speak, when prices are at rock bottom. And the other very significant aspect is our role in sustainability within the industry. Okay? Most of the palm oil that Apical process and sell are from third-party supplies, notably from smallholders. We are proud of the fact that through our positive engagement and persistence with our suppliers, we made considerable progress in the transformation of the industry on the sustainability front. We did this
Okay.
using our own group estates and mills as examples and proofs to show that sustainability pays. We gave persuasive reasons and compelling value propositions to win over suppliers to join us in producing sustainable palm oil. So on Scope 3 carbon reduction, we even managed to persuade supplier mills to invest in methane capture projects and to assist in waste oil recycling for renewable fuel. We use modern technologies such as satellite image for compliance monitoring and also engage local NGOs to assist us on the ground. Through these collaborations, progress gathered momentum in recent years, and the industry is in a much better position with regards to sustainability than it was, say, 3 to 5 years ago. Both our suppliers as well as our customers will be happy with what we have achieved together, I think, regardless of where the price cycle may be, super or otherwise.
Okay, Dato, thanks for that. I need to bring some other people in. Ben, can I just come back to you? Is it possible to get bullish on fossil fuels at the moment? I mean, do we think that oil could enter this super cycle? Obviously, the price has been good this year. It's up to sort of 85, its highest level since 2014. But can a lack of investment propel oil into a super cycle as well?
Well, I would imagine I don't know what the definition of a super cycle is, but I think oil is already in it. Most producers are generating EBITDA margins, well in excess of 50% at current crude and Brent prices. So, very healthy levels. It has been driven by a complete, lack of investment, like the hard rock commodities. Very similar story for the energy commodities. There's not many projects that have been permitted for a number of years now in terms of deep water, FID projects, and this is set to continue. And I think this is at a time when we have zero interest rates. There's sort of an increasing, awareness from central banks that we're in a bit of an energy bind here, because I think we all want to move to this renewable, 100% clean green energy. Of course we do. It's the best possible scenario for our kids' future. But there is a transition period, whether it's 5, 10, 15, 20 years, and during that transition period, if we don't manage fossil fuel production, we're going to continue to have extremely high prices. And if you put on top of that rising interest rates, that is not going to increase oil supply. It's going to decrease it in all probability. If there wasn't any investment into oil or coal with zero interest rates, it's very hard to see that with interest rates rising that there would be an increase. And to be honest, it's the same with clean and renewable energy. I mean, they're very capital intensive up front. Wind farms or hydrogen plants or nuclear plants are incredibly more expensive from an upfront cost than fossil fuels. So if interest rates were to increase, you're going to see supply issues there. So I think either way, interest rates are going to be rising. Interest rates would be incredibly bad for energy supply. They'll be very bad for oil, and I think that would maintain high prices. Whether we can break into triple digits, I think will largely remain on the back of US supply responses, which again I think will be somewhat paired to where interest rates go in 2022 and 2023.
Yeah, I'd agree with that. It seems like the discipline in the US shale industry is holding, so there's no reason to expect, sort of a huge tsunami of supply. David, can I just come over to you just a point around inflation? I mean, we are seeing some big inflation prints coming in around the world. I mean, we saw a big one in the
Yeah.
US last week. I mean, how much? I mean, there are a lot of clients coming to you at the moment wanting exposure to commodities as a sort of inflation hedge. Is that something that you're noticing?
Yeah, look, there's a number of key themes behind commodities. Certainly, inflation and people looking for beneficiaries from an inflationary environment, and also things like gold as a potential hedge against inflation. But you know, as we've talked about for most of this session, the key theme people are looking at resources is really around energy transition and that long-term theme.
Okay. And I mean, is it possible for you to get bullish on sort of fossil fuels, oil, and even thermal coal, which seems to be the most detested commodity out there?
Yeah, look, it comes down to supply and demand, you know, and I think what we're seeing at the moment is supply or productive capacity is falling faster than demand. So it's putting a squeeze on prices, and particularly this time of year as we move into the Northern Hemisphere winter, you know, we're really seeing that. I think what it highlights is that while people want to make that transition, you got to keep the lights on and the heaters on, which is a bit harder. Thermal coal, you know, the way I'd describe it is, you know, to use a Warren Buffett quote, and that is, it's a cigar butt. You know, there's a couple of puffs left, but the long-term future's not great. And I think that's really where thermal coal is. Again, while you need it for power production and there's no alternative, it will do okay. And as Ben was saying, you know, there's not a lot of new supply, and it's highly unlikely that new projects will get off the ground. So the economics look pretty good in the short term, but long term, it's just a matter of time.
Okay, right. We've got one question come in from a delegate, and he asks, how much of the current commodity cycle, other than decarbonisation commodities, is driven by logistics and shipping disruptions, all the way to the end product consumer, rather than any secular demand growth or supply reduction? I mean, Dato, have you seen a lot of logistics and shipping issues in your commodities around your business?
Yes, in some segments, particularly in items that are required to be shipped in containers. So we are seeing massive disruptions there.
Okay.
So I would
Ben,
say
I mean, yeah.
the supply chain. I would say supply chain disruption do contribute, you know, to a significant extent.
Okay, and are those disruptions getting any better, or are they still as bad as they were, say, 6 months, a year ago?
They are improving, but still, you know, it's not easy to get containers to far-flung places. You know, the only place where it is fairly normal is, you know, containers to China, but you know, to US and so on is extremely difficult.
So Ben, is this really just about supply chain disruptions, this sort of, you know, massive move up in commodities that we've seen this year? I mean, clearly it's played a part, hasn't it?
Look, I think the supply chain issues are, I would say, far less than the labour issues for the sector. And, you know, as I said, I think, you know, about 50% of those labour issues are transitory. Yes, you know, COVID, you know, the Western Australian border will open at some point. There will be better availability into Chile and Peru and South America at some point. You know, that's unquestionable. But you also do have a structural shortage of skilled labour in the mining industry. I mean, if you look at the Kalgoorlie School of Mines or the Denver School of Mines, there haven't, you know, the number of graduates coming out of those mining schools for the last decade have, you know, been down 50, 60% on what they were the decade before. So there is a genuine lack of skilled labour in the sector, and that is forcing things higher. There's also, you know, I think the added issue, which is, I think, going to be the biggest inflationary point to the sector, and that is rising carbon prices and offset prices You're seeing all of the major producers of energy, fossil fuel energy, and all of the major miners are now buying into reductions by 2030 and zero by 2050. That is going to materially increase the cost of production for these mining companies and energy companies longer term, and that was going to completely reset the cost curve for these commodities. To a point where we're now paying more attention to greenhouse gas emission curves per commodity than we are traditional cost curves. And you're seeing that across all commodities projects and producers that have lower carbon emissions are trading on higher multiples, and projects are getting taken over that have got lower emissions. So, I think the supply chain issues that we're seeing, whether it's shipping or whether it's labour, I think they are reasonably transitory, but we've got far bigger inflationary issues in the sector over the course of this decade.
Well, sadly, we've run out of time, and there was one subject that I did want to touch on there, but sadly we won't be able to, is carbon, and just to ask whether carbon is going to be the next major commodity or not, which I think it possibly can be, but that'll be hopefully addressed in another session later on. Okay, well, thank you all for joining me. Next up, it's our panel on strategic commodities and great power rivalry. Do stay with us.